So let's talk about hedge funds. They are on the comeback trail with assets rising $30 billion in May. That's the first uptick in close to a year. And that's after its worst year on record, according to Eureka Hedge. But for those that put their money into managed futures, they've been enjoying gains, while other assets have been bleeding losses during that time. According to Macquarie's data, between July 2007 to April of this year, managed futures programs have returned 17%, while global equities have fallen 44%. And the outperformance is just one reason that Macquarie is launching its own managed futures fund for its clients, which starts operations this month. Let's get more on this winning strategy and talk to George Tabaya, head of Macquarie's Fund of Hedge Funds, and he joins us today from Sydney. George, so interesting timing on launching this fund. I mean, we have bonds and equities on the rise once again. Doesn't that really negate the need for managed futures, which really helps hedge positions?
Good morning, Suzanne. That's not really the case. The reason why we are approaching the market with a product of such a kind is because we feel that there are some structural challenges that investors have been facing that are very clear to the eyes of an investor on the back of the global financial crisis. And these issues are the following. One, starting with liquidity. We're all clear about how difficult liquidity has been to traditional hedge fund strategies and the issues that come with it in terms of redemption suspensions for investors. Secondly, what was very obvious in the last year is levels of transparency associated with some more complex hedge fund strategies were issues that came to the fore. And lastly, which is something that we've always been concerned with over the last few years, is the increased level of correlation amongst asset classes and amongst strategies. So the premium that one has to attach to a genuine diversifier has to be something well regarded. We strongly believe that managed futures exhibit the following characteristics. On the liquidity front, because of their nature of investing through exchange-traded products mostly that are very liquid in nature, the liquidity issue is not as severe as one would think about with traditional strategies. So they're relatively liquid. Transparency is there as well for them. Daily transparency can sometimes be available in terms of positioning. And lastly, the diversification argument is very clear because these strategies do not necessarily have a structural long bias to markets, and because they are responding to analyzing price movements and are very agnostic about being long or short, that diversification argument is clear. So the idea behind presenting this product to the marketplace is to provide much sought after characteristics that the investor values more these days.
Now, George, you're talking about premium. What exactly do investors need to pay in terms of a fee structure for this new fund? I mean, you need a minimum of $20,000 just to get in. Do they also have to give you 2% of assets and 20% of profits as standard?
Sure. The fee structure is one about a management or risk advisory fee structure. So it would be a 1.5% fee at the fund level. And that is all that's being charged at the fund level. There's no performance fee structures or additional fees that people should be concerned with. Apart from that, you're right, the underlying CTA or managed futures managers will be charging their typical fees, and they tend to range between 1 to 2% on management and 10 to 25 on performance.
10 to 25%, so that's even above the standard 20%. But let's talk about the $20,000 minimum amount. That actually piqued my interest because it's actually quite low for these managed futures funds, these CTAs, which usually requires about $50,000 to $100,000. So I'm interested to know, why are you reducing this minimum amount?
I think the idea here is to make this product slightly more available readily, easily to the sophisticated investor or the accredited investor that tends to have a broad portfolio at present with limited cash available for dispersing into new strategies. So we're not targeting the basic retail investor at this point in time. This product is designed for sophisticated or accredited investors, but the minimum is one about striking a balance between very high access, which is difficult, and the lower end of the market that requires some diversification.
And isn't the lower fee structure also because it's a brand new fund? It really doesn't have a past track record, which a lot of people pick managed futures funds on and CTAs on. For instance, you can't, I guess, correlate on drawdowns or rate of return since it is brand new.
The product is brand new, but of course the access that we're providing through this product in terms of the underlying CTA managers is one about providing access to a mix of very well established managed futures traders, as well as CTA traders that have emerged in the last few years providing access to a niche strategy. So the underlying process that we have in place in terms of conducting analysis on these CTA managers and verifying their credibility is one that we've been employing for about 8 to 9 years. But going back to your key point on fees.
Yeah. Go ahead, continue.
Sorry, the whole idea here is just to provide as lean fee structure product as possible to give access to a wider array of investors. So that is the whole idea.
Now, George, I'm sure a lot of people watching are probably asking the same question. There are so many CTAs and managed futures funds out there. What sets Macquarie apart?
We have been looking at this space for about 8 to 9 years. We've been investing in this space for a long period of time. We know the CTA universe very well. We know how it has evolved over time. And
but George, what about strategy? People are asking, yeah, how do you invest your money that would actually make, I guess, your returns more fruitful than someone else's?
Sure. So thanks for this question. I think the key issue that comes to CTA investing is to really understand the risks associated with them. We are all reasonably clear that they are trying to capture trends, either a short-term trend or medium, or for that matter, a long-term trend. But the key issue is the risk management aspect of it. And what we have seen over the years is that they have the propensity to experience historical drawdowns that could be double-digit in size and could be very painful for investors. So what is important is to recognize the sources of risk that each style of CTA investing offers. And the value add that we're trying to provide through this product is to intelligently combine different styles of CTA investing to provide a profile that can have a lower drawdown potential than through a single CTA exposure that can suffer significant amounts.
I'm going to break it down for you then. Let's talk about commodities first. This new CTA fund of yours, which commodities are you mostly going to trade in?
The underlying universe that the managed futures traders look at and trade is a wider array. So predominantly they're trading futures instruments on equity indices, futures on short and long end of the interest rate curve, futures on commodity products, and they also trade the spot and forward FX markets. So it's quite diversified by asset class.
Can I get specific here and ask you which sort of commodities futures are you trading?
Yes, the underlying CTA managers generally trade the energy complex, and they also trade the base complex. They trade the agricultural complex to a lesser degree because liquidity in those markets tend to be less compared to the energy and the base sectors. But they tend to be quite diverse.
Okay, George, we're going to head to a commercial right now. Stick around. We're going to talk more about in terms of what sort of currencies you're trading in and indices as well. We have George Tabai of Macquarie talking to us from Sydney. More money-making strategies after this break. Of course, we're still waiting for your emails. If you want to send them along, asiaedge@bloomberg.net. Welcome back to the Bloomberg Edge. Macquarie is launching their new managed futures fund. We're talking to George Tabai, who is the head of the fund of hedge funds, joining us from Sydney. And George, before we went to commercial break, we were talking about the specifics of how your new fund is trading. Let's talk about the indices that you'll be isolating and following as well as part of this Trend Followers trading program that's part of your new CTA.
Yes, in terms of equity indices, the managers that we have employed in this product, they trade generally the developed world equity index product range, and they also augment that with the more liquid equity indices from emerging markets, inclusive of Asia and Latin America. And for that matter, when we look at currencies as well, their traditional markets have been G7 and the cross-currency rates within G7. And we do have some CTA managers in the portfolio that have extended their research in the last few years to start trading some of the Eastern European currencies and Latin American currencies through the OTC markets, because the opportunity there is less looked at and more exploitable.
Okay, well, in terms of currencies, which specific ones are your fund managers looking at to follow?
Generally, the CTA managers are employing their rule-based models to analyze price patterns in the markets to identify trends that they think are exploitable. So the universe is quite wide. What it tends to be triggered in terms of opportunity set is really a function of their assessment of trend emergence and trend continuity. At present, what we are seeing is most of the managers are trading less in currencies because currencies have generally been in a tight band in the last few weeks. Hence, it has been quite noisy for trend followers. So the risk in the currency cluster has reduced significantly compared to last year when they were very active on the yen, the euro, and the pound.
Okay, George, let's talk about returns then. I guess over the next 6 months to 1 year, what sort of returns is Macquarie targeting with this new fund?
The targeting returns is always a difficult thing with investment strategies, but I think the key thing that we are very productive and feel positive about is that the opportunity set has structurally improved for trading strategies in general, whether it is systematic strategies such as CTA managed futures or it's discretionary in nature. And the reason why we say that is that if I can isolate the period of 2003 to 2007, it was really characterized by very low and suppressed levels of volatility in the marketplace, which generally has not been highly productive for some of the managed futures traders. What we are seeing is that a return to a normal level of volatility, which is very constructive. The other thing that we think is a supporter of the structural backdrop to this opportunity set is that the markets are increasingly sensitive and receptive to macroeconomics and the response rates of authorities. And more importantly, wherever you go throughout the world, there is an increased level of common investment thinking that's manifesting itself into more focused liquidity patterns. And these are
George,
resulting in trends.
George, let's get to... Yeah, we have to get to some viewer emails. They are writing in to ask about your new fund. For instance, we have Rishi writing in, and he wants to know, George, if we believe that the U.S. will not be able to honor its debt repayments in the future, how are hedge funds, institutions, or individuals themselves hedging?
It's a big topic. Clearly, it's one that is considered at the moment by the wider investment community. I think the risks and the balance of risks are towards far more difficult management of these deficits. So an investor has to be wary of risk assets that are linked to that variable. And the diversification argument holds very well. And if you look at styles such as CTA managers, where they are simply trying to detect those changes in mentality in the marketplace and liquidity flows, I think that is one style of investing that you could rely on as being an anchor in your portfolio that can help you deal with these issues. So if I can put it in context, if you're talking... If I can put it in context for you, and sorry to interrupt, is that if you look over the last 10 years and look at the crisis conditions, whether 97, 98, 2001, these styles of investing have responded very quickly to those market reactions to crisis and have capitalized on it. And one of them is the CTA style of investing.
George, that leads us to our next question, next viewer email. This comes from Tayas. Hopefully I'm pronouncing that correctly. He wants to ask about this new strategy that Macquarie is trading these new CTAs, but he wants to know, what is your short 6 months and 1 year outlook on the underlying markets?
I think I'll answer the question in a few different ways. It really first is a function of the exploitable opportunity for those trend following and managed futures traders. Over the next 6 to 12 months, if you have a view that there is going to be an emergence of exploitable trend opportunities, whether in equities or interest rates or commodities, whether they are long or short, then you could be assured that those styles of investing are going to be there to try to capture them. If the markets are going to continue to trade in a very tight range and a significant amount of noise is going to prevail, generally most strategies will not be productive. So 6 to 12 month view, if you believe there's going to be some adjustments to current asset prices and levels of asset markets with some discipline in terms of trend emergence, then these strategies can be productive. So we've seen that in '07 and '08. We've seen that in prior periods. At this point in time, the first few months for the CTA community, it has been relatively flat to down because most of these trends have been exhausted, and we've seen a period of congestion and rationalization. So trends do emerge. All you have to do is set the right time frame for your mind.
Okay, George, thank you for joining us today. Good luck on this new fund. George Tobia of McQuarrie.